Hey, everybody, welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we've got Ethan Mayers on the podcast. He is a venture partner at Palafox VC, amongst a lot of other things. This is a very interesting episode because he is ultra passionate. I think you'll find that out very quickly in the episode about early stage venture investing, entrepreneurship, and so much so that he has helped build and advise on entrepreneurial ecosystems across the globe, 60 in total. So whether you're a founder or you're a venture capitalist or want to be, I think you'll get a lot out of this episode. So let's get Ethan on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Ethan, welcome to the podcast. Thanks for being a guest.
Thanks so much for having me. I'm so excited to be here.
Yeah, well, let's jump right in. Give everybody that's watching and listening a little bit of an overview of who you are, where you are, and what you're up to right now.
Yeah, so my name is Ethan Mayers. I wear a bunch of hats. I've basically done everything in early stage venture. So I've chosen to say in the early stage, so that's pre-seed to Series A. I have been a founder on both sides, successful and unsuccessful. I've run corporate venture programs. I've worked with governments around the world to develop startup ecosystems for the last couple of years. I've been a venture partner for several different funds on the investment side. I just believe so much in early stage entrepreneurship, and I want to do what I can to reduce barriers and increase access to entrepreneurship in all forms.
Well, there's a lot to unpack there. I guess let's start in the very beginning. I like to know people's origin story a little bit around why early stage venture, why did you start businesses? Like, kind of walk me through kind of how this kind of piqued your interest. It sounds like a while ago.
It was a while ago. So I actually started, I went to school originally for engineering physics, realized I was pretty bad at math. Okay. And I just couldn't handle the math. And what I wanted to do was like build rockets. My idea was like build rockets to Mars. That's what I thought. I wanted to be part of the building the future. That's what I thought the grandest vision of the future from all the sci-fi books and all the future stuff that I read as a kid. Yeah. I took this documentary filmmaking class that absolutely changed my entire life. Because what I realized then is that the actual most powerful tool that humans have ever created to build a future different than the current present is story. I saw it reflected in so many different ways. And so I immediately switched my major from engineering physics to journalism, as one might do.
Wow. That's a
ended
big
up
pivot.
It is, but there was you can't major in story, and I wasn't willing. I mean, I think there are in a couple schools, but in school, I was in the University of Cincinnati in Ohio, eventually transferred to the University of Tennessee. Got a degree in business and trying to also figure out what do I do with the story thing, got into TV production and ended up actually becoming a TV producer, where I was a TV producer for about 5.5 years early in my career. And it was incredibly fun. Like you cannot have a better career in your early 20s as a TV producer. But I realized that I was producing other people's art. And the reason why I wanted to get into it was to produce my own art. And so I would rather produce my own art on nights and weekends, but what can I do for my vocation that's more lucrative, that's more not beneficial for society, but like I took stock of what I was. And I was since an early age, I've been a technologist. I'm not very much of a coder, but I've been coding since I was 8 years old. I've always been involved in computers, always tinkering with what they do. And I have this business degree. So I'm like, I'm good at business. I'm good at technology. Let's go figure it out. And I landed a job in private equity at a portfolio company of Warburg Pincus and small little company you might have heard of called Lehman Brothers, which would shape my entire life. So for those that don't know, in 2007, 2008, the economy comes crashing down. Lehman Brothers was one of the casualties. They took down the company that I was with too. I was basically number 6 there. I watched us hire 110 people and then completely dissolve because when Lehman went out, we went out too. Yeah. But my bigger issue was, I was in my 20s, too big to fail. This is like my first job, like in finance. What the heck is going on? I don't understand any of this and what all this means. I was like a purist. Capitalism is you build a better mousetrap and you make more money and you change the world. And that's not what I was seeing. So that is what set me off on my path to become early stage. I really felt that the solution to pig to fail, and I have the language now. I didn't have the language then. It was more of an emotion, a feeling, was people need agency, and that's what it's going to build a resilient economy, is from people having access to entrepreneurship. If they could, because that's what I watch. I watch a lot of my friends start businesses after the 2008 economic crisis. And so I wanted to be part of that. So I started a consulting firm specifically to help people figure out the path to entrepreneurship. Like, that's how it all started. And it was also to teach me how to start up. I actually had my own idea, which in the ensuing years, it would no longer be valid. But I was like, I don't know how to start up. So I want to learn how to start up. So I basically embarked on this multi-year journey to learn how to start up. And then fast forward, I sold the consulting firm to a private equity company. I went in-house for a little while. I went to another startup. I kept building, accumulating, and kind of going where the ball rolls. And the one thing I'll tell you to step back is, like, when I found early stage, I found my tribe. These were my people. These were the misfits, the crazies, the intellectuals, the people that would sit there on a barbecue and endlessly debate everything from capital theory to little historical facts, and be Googling things and wanting to understand and learn things. Like, the most important trait, I think, in our society is curiosity. And here in this group of people, and I still maintain it, I love anybody that's crazy enough to start something from nothing, because it is crazy. It's absolutely crazy. The universe is against you. Many cases, your family and friends are against you. It's an absolutely crazy adventure to start. I believe is driven by either almost a divine purpose and mission, and or curiosity. And when you put those two things together in a human being, I'm sorry, you get the best of what humans can be. So That's why I found my tribe, my purpose, and I just wanted to help and be part of that.
Yeah, no, we were talking before we started recording that I moved from Austin to Silicon Valley a few months ago, and I am literally in the belly of the beast of the crazy, the entrepreneur, the startup founder. And, I was at an event a couple of days ago, and I'm getting pitched these ideas that I don't know anything about. All of them say they're AI. Are they really AI? We don't know yet. But some of them are crazy enough to actually happen, right? And so I guess as you've obviously started a business, you've been in other startups, you obviously, we'll talk more about what you're doing now, but other than the curiosity and this divine kind of intervention, like, what are some of the traits that you see of the early stage venture founders that you've coached and mentored over the years? Like, what do you see as some of the traits that make them successful? Is it the person themselves? Is it the partnership, the team? Like, how do you kind of assess that as you think about the early stage? Because some people like to do it themselves. They're like lone wolves. I want to build it myself. Other people are like, I need to bring in partners that can help me, or other founders to help me.
I mean, what a deep question, right? If we had that figured out, we'd go into business right now with the best early stage venture company in the world, right? And which matters, actually, right? Because I want to separate that into two different parts. What are the traits that I've seen that lead to success are different than what I might vet out for in a diligence process. Interestingly enough, as much as those two things should be the same, they're not always, because a lot of the stuff that makes somebody really successful, you will never find in a diligence process, if that makes sense. You can try. You had my buddy Mike Ma a few weeks ago that tries to do the whole due diligence thing where he coaches people for like a month.
Yeah,
he's definitely gets it better, but some of these traits only surface after months and sometimes don't even surface at all. So that's why I want to separate the two questions into what have I seen. So one thing we didn't talk about, I've been to 94 countries. I've worked with startup ecosystems in 60 of them. So I've been lucky enough to see ecosystems and thousands of startups around the world. It's so let me start with what do I think leads to success, right? Which is different than what I diligence for. Almost every single very successful founder that I've ever met, they do share a couple of traits. So one of them is an insatiable curiosity. So they're constantly asking, like, why? Like Simon Sinek's 5 whys is not enough for them. These people ask 30 whys.
Got it. Okay.
They will just keep going and going and going because they need to have an answer. Number 2, they're extremely driven. They just are. Sometimes by purpose, sometimes by some internal mechanism they can't tell, but there's something that's not going to prevent them to stop, which is, on the other side, when I diligence people, two of the things I always ask is, what's the purpose? Why are you doing this? Because I want to try to find what's going to motivate you when things get really tough. But also the other thing I always ask is, what's your hobby? Because I think that I don't think it's healthy to get your entire identity locked up in work. So I'm also trying to get a bigger picture of who this person thinks they are and how they spend their time, right?
Yeah.
So they're curious, and they have there's this great saying that a couple friends of mine talk about, which is strong beliefs loosely held. Almost every successful founder I've ever met subscribes to that, which means they're 100% in to whatever they're doing, but they are able to receive information and change, but they do it, and this is the most important word, intentionally.
Mm.
And so, conversely, most of the unsuccessful founders have lots of the opposite traits. They don't ask why enough. They don't care enough. And on the loose beliefs, they'll come back from an investor and say, well, this investor hated my pitch deck, so I just spent all night, revising it. I'm like, well, do you believe in the new pitch deck that you've written? Well, not really, but it will get me money. And I'm like, no, it won't.
Got it.
Oh, no, it won't. I was like, no. Like, don't get me wrong. Like, we investors, sometimes we have good ideas, but we also have really bad ideas. And, we also are attuned to what we invest in. So we might not be even giving you good advice. So strong beliefs loosely held is like a big deal. So the idea is, it's a driven person who's absolutely curious to follow all the threads, is capable of thinking at the big macro level and the detail level in terms of just making sure everything's moving. And there has to be some sort of inspiration. So it's like inspiration and curiosity, because the real good founders, they have to, people sometimes mistake, especially early stage founders. And I have to kind of tell them, I'm like, you're not just attracting money. You have to attract talent to work for you. And sometimes in early stages for free. Let's be real about this. Like, really good companies might have to ask people to work for free or equity or a tiny amount of money. And the more you're able to be a salesperson, see, the CEO's job is essentially nothing more than a glorified salesperson. I'm sorry. And that's all they are. And in order to sell the company, they have to keep the company aligned. In order to sell on talent, they have to be inspiring. In order to sell investors, they have to be convincing. But these are all aspects of a sales job. So that's the other thing, is that almost every successful founder I've met are really, really good salespeople. Now, the reason why you can't find all this out in diligence. So separately, what do you look for? Conversely, I'll say, like, what are the big mistakes, right? So, like, you need to operate in a big market. I have seen amazing people just solving a problem that's way too small for their talent. You can't see anything.
Yeah.
As an investor and even a human being, I can't sit there and say, hey, Justin, you're literally one of the most brilliant people I've met. I don't know why you're focused on this particular very niche. I get it. That's important, but it's not going to yield. Or if it is, just build a durable business. And that's the other thing I want to, not everything has to be or should be venture.
Yeah, I was actually going to kind of bring that up, because there's a lot of people that they think that in order to be a founder or to be a success, you have to build a $1 billion unicorn business that you IPO. I'm a big believer in, not every business has to be 100,000 people. Every business can be, if it's profitable and it makes you a lifestyle, and even if it solves a small problem, it can be a success. It's just it's a different measure of success than I built a $1 billion company and sold it to, XYZ company. So I think if all companies had the aspiration to be $1 billion, we wouldn't have all the small mom and pop businesses that are wildly successful today and create a great life and create jobs and all that stuff. So,
but I'll go even farther. So, and this is a lot of what I talk about today is what I call capital innovation, because the VC economy, and I think it's great. I think venture capital is one of the most elegant economic theories we've ever created. It's a great way to align risk and capital. And it works for really global changing, very fast moving businesses that can accumulate market share very quickly. So I love it. That being said, it's becoming less and less appropriate for many startups and many entrepreneurs. And this is what I've seen. And one of the things I'm doing as just a mission, a project, I don't even know what to call it other than that, is I'm trying to document. And my team and I have already documented over 65 funds that are operating in what I call venture adjacent. So they're actually building their entire portfolio not organized around finding a unicorn, where a unicorn is a nice to have, but not a necessity. It's not built around the power law. It's built around, one. And I'm seeing the emergence literally in front of my eyes of new asset classes. I'll give you an example of two. One is called SMV, small to medium ventures. These are companies that are designed to sell for $50 to $500 million in usually a shorter period of time than in venture capital. These are very successful businesses. And not only are, and I want to make sure these are not quaint businesses, depending where you are in the world. And I'll even use examples of the United States, in middle America, in the non-traditional Silicon Valleys or New York. in a lot of countries around the world. I had a conversation with a venture capital firm today in Poland. Like, you get a $300 million outcome in a state that doesn't have a strong traditional background. I remember I was talking to a professor from Ohio University, and he said, I think the biggest exit they had was $260 million. They're in Southeast Ohio. For that region, that's game changing.
Yeah.
That changes the whole economy, that changes everything. So not only do I think that, I think it's great if you're a venture-backed company and venture backable, and that's the path you're going. And I think it's absolutely great if you're not, if you're creating $100, $200, $500 million economy. And then there's something called permanent capital, which are companies designed never to exit. I think it's wonderful. My mission, my goal in life is to try to promote agency through access to entrepreneurship, reduce barriers, increase access. And so the more that we can increase the menu and sit down and talk to an entrepreneur and say, Justin, all right, let's talk. Okay, here's venture, and that's what that path looks like. Here's the SMV path, and that's what that looks like. How about you don't sell your business ever, and here's what that path looks like. And then that's how I think we're going to create such amazing outcomes in this world and fix all the problems that we have. I think so many of the problems we can fix through entrepreneurship, and it's going to be an army of people with a menu of options solving all these problems.
I want to dig in that to what you're just talking about a little bit more around what does it mean to be venture backed, and what should a founder know that maybe has never been exposed that much to what it means to be a venture backed company? Because yes, you still own the majority of the business, but you have bosses now, right? Like, you have very aggressive advisors and people that have very aligned outcomes to make sure that you are scaling the business so they can exit and return money back to their LPs. So I guess, what are some of the things that somebody that is listening to this, if they're thinking about going down the venture route, what should they be aware of that are pluses of having venture as part of their cap table, and also maybe some things they should consider to make sure it's the right path?
No, it's a fantastic question. So you're sitting there with a business and you have to make a decision, right? And one of the frustrations that I've had is that venture capital has been perceived as like the only or the main path. And so I wanted to dispel that. Yeah, it is a path. And for the type of business that I'll describe in 1 second, it's the best path. And depending on the business that you're running, it may not be the right path for you. So I do want to put, I feel like a caveat, disclaimers out there, right? So if you're sitting there somewhere in a state, region, or country, and you're sitting on what you think is a disruptive idea. So let's talk about what disruptive idea, right? So it's going to literally displace current ways of doing things. So very famous, and one of my favorite, Netflix said that their primary competitor is sleep. And sometimes they actually document how, they're causing people to sleep less because that's where they're squeezing hours from. So you have to know what your people are actually doing and saying, I can actually make a meaningful difference. So you're in a region somewhere and you believe that you can get appreciable market share in a very short period of time. And you could go up against, with the right skills and talent, you could go up against whoever the big players are or displace the current conditions of the market environment, get anywhere from 3 to 15% of the market within 4 to 8 years, depending. And your primary obstacle is speed. Not access, not money. Now, I should caveat this again. I'm sorry to caveat this. I'm excluding deep tech, crazy stuff like pharma and stuff that just needs a lot of capital. Like, you're not going to build the next orbital space station or cure cancer on a $2 million check from your uncle. Right. So I'm excluding that. So those companies are all deep tech companies. It's very different. That is, I truly believe that I'm building some sort of innovation for humanity and I need a lot of money to get it to the next game. Right. But let's ignore those companies for a second. So my primary obstacle is speed. If I know what to do and if I had money, I would run a sprint because it's a land grab. Because once I start going and once people realize how awesome I am, I'm going to have a relatively limited window in order to grab that market share because success begets competitors. Yep. And so I want to outrun everyone around and go big. Okay. Now, everyone is going to say, that's me, that's me, that's me, that's me. So let's talk about the cost and the consequences. There's a lot of talk about burnout, depression. There's still a debate about whether people with mental health issues are attracted to entrepreneurship or entrepreneurship causes them. It's probably a mix of both.
Yeah, got it.
VCs will we'll abandon you. Not because we want to, right? But we have to focus. We invest in, let's say, the power law is investing in 10 companies, assuming that 9 will fail and 1 will give us an outsized return. So we're assuming 9 will fail. And when they fail, I've been actually on the side of the founder side. I was helping a friend of mine where their investor just kind of gave up for them. They stopped returning phone calls. They stopped helping. This was this is a functional business. It had some clients, had some money, but the VC just not returning phone calls, not giving you interest. And now you become a pariah because you have this person on your cap table that doesn't want to talk to you. I had another example of a company. I'm trying to remember the details, 10 or 20 million in, and the VCs just, they had some clauses, lots of crazy, make sure you get a good lawyer, but the company just wasn't growing fast enough. And I forgot all the details, but legitimately they were going, if it was an Ethan and Justin business, it would have been fine. But as a venture business, it was not growing fast enough. And the venture company just killed it, literally killed it, shut it down. Said, not only you're not getting your next round, like you're done. Like
you're not getting any revenue, you're done.
You will return the rest of the capital. It wasn't that much left. I want the rest of what money you have, and you're done. I've seen cases where the CEOs and founders are ousted. So, you suddenly get a partner, like a marriage partner, like a serious marriage partner that you're stuck with for the life of your firm that's going to help you define success. I was doing a speech once and I was talking all about positioning and framing and how like the easiest time to do that is in the beginning and saying, look, I'm an Ethan and I'm only going to grow 50% every year and you're going to deal with that and you're either going to invest in me or not. It's being extreme.
Yeah.
Because like, whatever, you're buying into me or you're not. And this guy like raised his hand. He says, well, what if I told the investors, I forget what it was, but like, what if I told the investors I would 3x the company? And I was like, well, then you have to.
Right.
Like, what do you mean? And you could see his face just go, what?
Yeah.
And I'm like, that's not fair. Like, I'm sorry. So if I had a message to people that were considering whether they get venture or not, make sure the values are aligned and like, what your goals are and make sure you actually have that conversation with the investors. Like be really upfront with who you are and what you want. It's better to not have received the check than actually to. The worst fear of every entrepreneur should not be failure. It should be forced to be the architect of your own failure or turn into something that you won't. Like the worst example that I can think of, just like to be really extreme, is you're some super green, super climate friendly company that's bought by a big bad oil company and forced to do big bad oil things, right? I'm being exaggerating, right? And if you think that's not a possibility, you're wrong. Right. Like that's a fate that's worse than failure, right? So there's a great book. Eric Ries has the book Incorruptible. I'm reading it now. It's brilliant. It's a game changer. I recommend it for everyone. And it talks very much about this. So like to everyone, so number one, are you on the venture trajectory? Which is I am doing something where the primary obstacle is speed, where I know that I'm going to have good economic profits and margins. So the definition of usually a venture backable company is that there's very little marginal cost for the next user. So like for Instagram, not marketing cost, but like for Instagram to literally add a user to the Instagram computer is like negligible. That's very key. So there's the potential for lots and lots of profit margins over time. And my primary obstacle is speed, and I want to go global, and I know that I can immediately disrupt and displace. And I'm willing to basically put my life kind of on hold for a couple of years. Like this is my primary, and that's okay because I know I'm sitting on something that's so valuable, so amazing. I have to do this. I know the risks. I know that I'm more prone to potentially burnout and depression, but I feel so convinced that this is going to be, and then when I look at companies that are venture backable, and I look at the last 15 years, an Uber, an Airbnb, a Google, a SpaceX, it would 100% make sense for me to be in that same sentence, which is not to say if you don't build something like that, you're not successful. I think some of the most successful companies are fine not doing that. But like that much gravitas and culture, because let's be also very honest. In 2026, the most powerful thing you have right now is distribution and influence. That's what all of these companies have. And so you're also trying to become a little bit of a cultural icon is necessary. And so if all of these goals align, great. Just go in and have a real honest conversation with your investor and make sure that's lined up. And it works. It can work really, really well.
I'm curious about some of these other countries that you've built ecosystems in, and also to kind of dig it a little bit more to this other forms of capital, this SMV and this permanent capital. Because I actually had a meeting with a private equity group I met out here and they don't call themselves a family office because when I hear permanent capital, I think family office, right? They are building wealth for the family, for not just this generation, but for future. So they may buy a business and never sell it, right? Because it's just a good business to keep and own. And then I guess, so how do you define permanent capital, and what businesses maybe best fit for those? But then I'm curious about learn about the global side of your experience, because a lot of the VC firms I look at and talk to are US based, and they hire and they invest in companies that are here in the US. And obviously you've got built 60 or so ecosystems around the world. So I'm kind of curious how they think about venture and early stage that may be similar or different to the US.
Yeah. So on the first one, the research is still early. I've been involved with this for about 6 months, but I don't know how much you know about seed strapping. Have you heard about seed strapping?
I've not.
So seed strapping is the concept where I think I can get to a viable, resilient business with one, maybe two rounds of funding.
Okay.
So I'm not right. So
it's
like
bootstrapping, but raising. Yeah, got it. Okay.
Exactly. So there's a lot of businesses, especially AI businesses, where the cost to create has never been lower. The accessibility to build a company. If we look back at the last 40 years of technology, right? When we start in the 70s or 80s, the primary obstacle there was computing power. I mean, we're talking about mainframes that were $1 million in the size of a house. Like, it was ridiculous. It was very difficult to get those things, to get access to them, right? Come the 80s and the personal computer revolution, from the 80s to the mid 2000s, you're talking about the primary obstacle being development. Now, if you were technically abled, the cost of the compute came down, but now the cost barrier was cost to develop, right? And so this is when you get the superstar developers. And if you know how to develop efficient code, I just want to throw that out there because that's important. If you knew how to efficiently code, then you became suddenly valuable. Well, those are gone now, right? So compute is next to nothing. Yeah, you could complain that it's $200 a month on Claude or whatever, but compared to $1 million mainframe or anything else, like, it's never been easier, right? And we can talk endlessly, and that's for a different podcast, about AI coding is obviously not where it is right now, but to get the first barriers, to get an idea out of your head basically into someone's hand, has never been ever easier in the world. Which also means there's a lot of paths to go. There's the traditional venture where we discussed you can go to the moon and you think you're going. There's the go to orbit, the SMV, small to medium venture. I think I'm going to build this, and I think it's going to either be a valuable company that's minting me 10, 20, 50 million in revenue, and I could sell it potentially to a strategic acquirer or corporate. Or, I think I can get a couple million right now and get this to a place where it's making me 5, 10, 15, 20 million a year. And I would just keep it and run it, because why not?
Right.
So that's kind of like, that to me is where permanent capital is like sitting. Like, I've got this very interesting company, 5X Capital, down in Peru, that buys what they call off-track venture companies. So what they do is companies that had previously gotten VC but are no longer on the unicorn trajectory. Because, like, just because you tell me you're a unicorn doesn't mean you're going to get there. What if, 2-3 years later, 30% year over year growth is a great company, but it's definitely no longer on that crazy trajectory. By the way, just so you know, like, some of these crazy unicorn companies, you're talking about like 80x growth in like 12 to 18 months. These are like really unlike anything you've ever seen, right? Yeah. So, like, you double the company every year, triple the company every year. That's really great, but you're never going to achieve, liftoff speed. So they go and invest in off-track VC companies who now basically have minted a usable cash flow based model, give them some money to pay back some early investors, give them some growth capital, and basically turn the business into a permanent business.
Is that kind of akin to like more of a private equity fund? Like, because they're, they have a little bit more of a longer horizon. They're typically a little later in the game, right? So venture is like high risk, high reward. And to your point, you're buying 10, expecting 9 to fail, versus PE is like, invest in 10, 7 or 8 are good, 2 fail, or something like that. Like, it's a little bit of the inverse.
Yeah, and I could geek out on this, and I won't. But because the ontology that we have is incorrect. Everything that you talk about right now is private equity. VC is just a subset of private equity.
Right. Yeah, it's like whiskey and bourbon. Bourbon is a whiskey. Everything is
Exactly. So really, the questions for these things are, and the ontology it gets really loose because everyone calls each other everything else, and it's very strange. And let's be honest, like, where's the separation? Because the Justin Co. gets an investment from Ethan Ventures as an early stage, but is getting private equity money at Series B or Series C, and getting institutional money by Series D and sovereign wealth funds at Series E. So, like, all of this stuff is just money. So that's why, look, as a nerd, I think these things can be cleaned up a little bit, which is one of the things that I'm trying to do with naming things and playing around with it. But what we're talking about is input. So how much cash does the company need? What's its baseline trajectory, and what's the potential exit? And when I talk about exit, I'm meaning in a very broad sense, which is basically value returned to the investor. So most PE, as they call themselves, won't play in games under 40, 50, 60, 100 million or more. So that's where these things kind of get in, which is why, look, I met a company, like, I'm excited because, and hopefully you can see it, because genuinely, I think my whole thesis is that capital is a technology. You cannot find evidence of anything, you can't find evidence of cap tables, term sheets, LPs in biology, chemistry, or physics. It's a technology. We invented it. I could tell you where we invented it. I could go into that. I won't for now, but we invented it, which means we can invent it again. I met one company that what they do is they look for, it's deep tech stuff. So they go into scientist stuff and they basically find a company, they find an invention, a patent that can be turned into a business. Yeah. They then pump a bunch of money into it and turn it into a micro cap public stock within 5 years. Like that's their model. Yeah. Now I'm not saying the labels are bad, but we start labeling that as like, what the heck is that? Because that's a little bit of venture, a little bit of private equity, a little bit of what the heck your model. And they mint like one company every year or 2 years. So it's like a very slow, and apparently according to them, and I think they are very successful at it. But I'm like, first of all, you're not going to have like 50 of those. And that's fantastic that model exists, because what I want to see is lots of models and lots of things exist. And I think what we're doing, we're watching the emergence of all of this innovation around capital. And I think it's fantastic. And I've talked to a lot of my VC friends. Like I said, I work for a VC fund. And I think this will actually strengthen VC, not the opposite, because we already know that VC is kind of concentrating. We see that, we sense it. VC tends to write fewer checks, usually at higher dollar amounts or early conviction, or they're getting in early and they're applying more money to follow on rounds. There are plenty in the last 10 years, VC funds who would basically get in early and reserve a lot less follow on. And now it's like, no, you got to get in early, follow on, keep your dilution, your dilution stable. And so from that standpoint, it's really interesting. But I do want to shift, because you asked me about international. Yeah. Which is, if that's okay.
Oh yeah, absolutely. I'm very curious about what other countries are doing, how they're supporting the VC kind of entrepreneurial ecosystems. It feels like, again, we have these bubbles in the US of, Silicon Valley, Austin, Seattle, New York, wherever. I'm just curious. I don't know enough about the other countries and how they think about early stage and how they support entrepreneurs.
Yeah. I mean, so in the US, what do we tend to fund? We tend to fund really big, bold ideas, which is fantastic. That's, we can land rockets and create transportation systems with our phone. And it's so cool that we can do that, right? But we also invest in a lot of convenience products. Like, let's be honest, we can invest in a lot of convenience products that are just very difficult to do. In the US, we invest in moonshot ideas. Great book, by the way, Moonshots. We invest in moonshot ideas. We invest in a lot of convenience items, a lot of stuff that, frankly, I'm not sure that we need. Yeah. We're also a very capitalistic country, so we are the leaders in MarTech and a lot of advertising tech, a lot of ways to sell and extract more money out of things. But when you go to a lot of other countries, there's a lot of broken systems. And one of the cool things is that a lot of entrepreneurs are trying to apply for-profit, completely capitalistic models to fix broken aspects in their system. So I invested in a company in Bangladesh, for instance, where the healthcare system was so broken that they basically invented an entire logistics system to bring the medicine to you. So they would come and they would do your blood tests at your house, as an example. And they did quite well for the region, for the area. Yeah. And it depends where you go. So I go to a lot of countries that are a little more on the poor economic level. And so one of the things, and this is actually important, so one of the things is the government's realizes you have a lot of kids, and a lot of kids are into things like video games or content creation or influencer. That's, to me, you may not see it this way, but I see that as venture adjacent, because it's using technology as a means and methods of creation. And the only thing that's missing from that is adding the means of capitalism. So using technology as means of creation and capitalism becomes basically what a startup is. Basically, that's kind of one of the definitions. So they're trying to change the arc of their economic development. And one of the interesting things is some of them previously had tried to import the Silicon Valley model, which is the power law model. But when you're in a poor country and things are not going very well, And you then create an economic system where you're taking basically taxpayer, in some cases, taxpayer money, grant money, and things like that. And you're creating a system where 90% of people are going to fail. That's problematic. So you end up with two things that happen. The first thing that happens is you start thinking from an economic development standpoint that you're actually training the entrepreneur. Look, many entrepreneurs are not successful in their first time around. Many are successful in the second or third. So you're more looking at it like a generational thing. There's a couple countries that I work with that are doing it like that. Like the purpose is to infuse this knowledge into the ecosystem, right? And the second one is some of this capital innovation stuff where, it shouldn't be 90% failure, but let's focus on getting smaller wins more so, because that's also hope and inspiration. One of my dearest friends, he believes that we should be measuring our economy, and a government should be held accountable, not for GDP, gross domestic product, and the economic output and productivity a company produces, but it should be measured on the hope and inspiration it produces for the next generation. And I think that's a beautiful thing. So what ends up happening? I'm painting a rosy picture. It's fantastic out there. So let's be honest. What sucks about other countries? Number one, America has 300 plus million people and a lot of people that are well educated and well trained. So our actual middle management layer is actually quite profoundly good. And that is often sorely terrible almost everywhere else you go.
Oh, interesting.
So,
okay.
so look, I'll go around the world and I think you're great, Justin, and I'll find other great Justins. But then that great Justin in a poorer country tries to find a line manager and just really struggles. So, the top end founders are just as good as anything you find here, but then they struggle to find the next level. So that's problem number one.
Got it.
Problem number two, there's a lot of regulatory environment issues. I won't go too deep into that. I was once quoted by the Singapore Business Times because I was in Vietnam, and I said, so to domicile means like where your company's based. And I said, companies are only based in the country in only a handful of places around the world. And it's not because the US or Singapore are necessarily the most business friendly countries in the world. It's because we're the most stable and reliable. And what that actually means is, and I'll give you a very practical example. If a company is sued for whatever reason, you can actually put a dollar amount to that and that can show up on your balance sheet. Whereas if you go to a country where it's an unstable legal system, that's an unlimited amount of risk. So that's like one of the many, many reasons. So like I was basically saying, look, you should be focusing on the velocity of money in and money out, or money into the company and country and how it's spent, not where it's registered. So you've got middle managers are can be non-existent or very difficult to find. You've got a regulatory environment that usually causes you, almost everyone I know in many of these countries will be based in London or US. We are actually fantastic. The US is great on two fronts. We are great at company formations. It's very easy to start a company. And it's also very easy to go bankrupt. We don't take that into account, but this is a really big deal. There are a number of countries, I don't want to put a number on it, but it's more than 10%, it could be 40%, somewhere in between that, where if you start a company and incur debts, then you're legally responsible for that for life.
Oh, wow.
For life.
So your business can't go bankrupt, you go bankrupt kind of thing. Like you're
correct. That's exactly right. Look, US is great at storytelling, and we're great at, I think we do a pretty decent job of hope inspiration. You tell somebody you're an influencer, okay, whatever. You tell somebody you're an entrepreneur. In many countries, if you do that, you lose the support of your family and friends. So it's not even just that they're like, what are you doing, Justin? They're like, no, don't come to Christmas dinner, Justin. Until you get a real job.
You're a disgrace.
Yeah, so those are some of the issues, but then you think about it, like to overcome so many hurdles is you produce really great founders. So I actually was asked about this. I was in Peru last year, and I was asked, like, what are the differences between good and bad ecosystems, And one of the things I thought about, because when I talk to people, we have all the access to the same Reddits. We have access to the same information. So what's actually changing something? And I think you'll notice this now that you live in San Jose. It's not necessarily that you're getting better information than me or someone else. What you are doing that I think is very different, that you get in very few places in the world, where you are is one of them, where I am in New York is another, is it will be repeated multiple times. So there's something called new and cool on the horizon. We're recording this on a Thursday. You might hear about it for the first time on Friday and whatever. And then on Monday, somebody says it again. And then Tuesday, somebody in your network says it again. And then you're at a happy hour on Wednesday, and someone, that is what the difference is. So it's not that they don't have access to that. It's, I think for the most part, all of us generally, unless it's something really cool and specific to what we're doing, we kind of ignore everything the first time we hear it. It's the second, third, and fourth time we're like, oh, okay, well, okay. Oh, so that is going to really change AI. Okay, I didn't realize that that's going to have an impact. And so by the third or fourth or fifth time we're registering it, that's one of the difference between the ecosystems is they don't get the knowledge repeated.
Or it's not repeated fast enough, right? So you may hear the fourth time maybe 4 months from now versus 4 days.
Exactly. And that's why concentration of ecosystems, San Jose, I believe New York is almost as good as the Bay Area, in my opinion. But we get that concentration of knowledge. We get that distillation. And that's why, I push a lot for people to make the journey. Consider San Francisco like a necessary journey in the startup privilege. I am not actually a huge fan of necessarily building there. There's a lot of reasons why you shouldn't necessarily build in San Francisco. It's quite expensive. It's not right for every company. And I don't think it's necessarily the end all be all, but I think you need to have contact and presence because it is, for all intents and purposes, it is the strongest concentration of entrepreneurship anywhere in the world. And chances are, it's possible that your paths will cross at some point in this area. So I always talk about building those bridges to, especially to San Francisco, but even to your regional area. What will happen is tiny countries will basically go to the next region. So in MENA, they were going to like Emirates, Saudi Arabia, or the ones that they historically had ties to. So like Tunisia, they speak French, so they go up to France, right? So they're always going like to the next bigger region. And then once you get to the next bigger region, the bigger markets, like once you're in France, then it's all the EU, or it's obviously the big one, US, of course, not ignoring the fact that you could obviously pivot to Asia, but ultimately, like you do not become a unicorn unless you succeed in essentially a developed market. So basically it's just using your country as the test market, MVP, to go to the regional player, to go to the developed market, if you're on the unicorn trajectory.
Yeah. We're recording this episode in mid-June of 2026. So I'm kind of curious to get your thoughts on what the next, call it 12 months of the entrepreneur looks like, because there's all this chatter around, the first $1 billion one employee company with a bunch of agents. Do I think we're there right now? No. What could we get there in a year? I have no idea. But I guess I'm thinking about, I think you said it before, like even non-technical people can start a tech company, where that was much harder years ago, right? I can build an MVP using Lovable or Claude Cowork or Claude Code, and I'm not a technical person, but I can build something that I can put in somebody else's hand to test it out, to get some feedback on. And then if it's something there, then I can maybe go to a VC or something and get some more capital and build it, right? I think that's an interesting change that has happened in the last handful of years with AI. But if you think about the next 12 months, I have no idea where the world's going to go. But what do you think from an entrepreneurial perspective? Is it going to be better, the same, worse as an entrepreneur to try to build a business in the next 12 months?
Oh, man. Well,
I know that's a loaded question.
Well, no, it's not a loaded question. Prognostication is wrong. Here's my 17 predictions, of which 16 will be wrong. No, but and yet, just because you asked, I'm going to give it, right? So what do we have? We have a couple of different trends, right? So what trends do we have? I actually wrote an article called MVP, which is minimally beautiful product. We've moved past minimally viable product, and for better or worse, AI has now set a floor of what we accept. So you used to pull a shitty app together on a Saturday and show it to your friend on Sunday, and you're actually dead in the water if you do that now. So coding, interestingly, is no longer the barrier. It's distribution, and I'd actually argue design, because people just have no tolerance. And AI has smoothed everything to the middle. So I don't know if you've noticed this, but all my friends that used to have really bad grammar no longer have bad grammar, but they're not writing inspiring prose. So everything's moved to the middle. So the problem is you're going to be judged a lot more on design. So the first thing is pilots are they're already being discounted more than ever. I mean, it used to be, right? It used to be Justin and Ethan have a podcast. We get inspired so much. We start a business. We pull shitty design together on a Saturday. We go use our collective networks to go get 2 pilots, 2 letters of intent, LOIs. And out of that, we can get a $250,000 to $500,000 business. I believe that world is gone.
Interesting. I will change your grammar kind of comment around. I think about it for websites. And in my world, resumes. If you have a grammar error on your resume, you clearly aren't using AI. Like, just put it into AI and say, fix whatever is misspelled, fix some grammar. Don't change the resume and the content, but just fix the things. But also websites. Like, I wanted to create a website for a side business that I'm building. And I just went into Claude and I said, I put in like 10 words and it built me a beautiful website.
Same. My website's built in Claude too. And I'm saying, so that's one. So, and what I mean by that is I'm not giving you money. No one's giving you money for that anymore because we don't know if those pilots convert. And we've seen there's a word called tourism. I don't know if you've heard applied to this. It actually applies all over our industry. So PE played tourist when they decided they ran out of deals and they went into early stage and drove up the money. And right now, I don't know about you, but I've paid for probably half a dozen AI things that I no longer pay for just to try it out for a month or two. That's called tourism.
Okay.
So that's what I mean by that world is dead. So we're looking for dynamic, resilient businesses. So you're either building, you got two options. You're building some deep tech, really cool, something like really innovative where you have some unique line on it. Or if you're building a normal company, which is fine. The basic business fundamentals are here, which is, you got to prove that you can sell. You got to prove that a pilot converts an LOI, a free pilot is almost like design partners are almost basically dead. I think that's one of the big changes you'll see over the next 12 months. Like it's going to prove nothing. If you need to make money off of this company and, or need to invest in it, you're going to have to get somebody to prove that they're actually willing to pay for it. Otherwise you're dead. Number two, you're going to see a lot of people move into entrepreneurship that never were before. I don't know the word for it. I thought about some other words because I think it's forced entrepreneurship, but, and a lot of those people are not going to be building unicorns. They're going to be building $5 to $20 million businesses, but I think they're also going to change the course because you're going to get people, I think in a good way, getting a lot more business savvy and business education, which I don't think is necessarily a bad thing. So I think that's going to happen. I think VC is going to continue to consolidate. I've seen it all along. First of all, I wouldn't be surprised if at least a quarter of emerging fund managers and emerging and early stage funds go out of business. Many of them already are. Zombie funds are a real thing. I wouldn't be surprised, but the ones that remain are going to be funding we got really cool ideas coming up, but it is going to be the barrier to get venture capital is much higher. So I think you're also going to see extended family and friends rounds. Okay. Extended pre-seed rounds, angels trying to take up some of the lion's share. I think you're going to see a lot of interesting moves with strategics. I've seen a lot of early stage companies go to strategics a lot earlier, which is not necessarily a bad thing. Corporate venture arms can be open to that, not only open to that. But I think you're going to see more people becoming entrepreneurs, which means it's going to become more competitive. And I think you're going to continue, not that I hope this prediction is wrong, but, CEO, founder as thought leader, influencer, I'd almost say is still in the early days. I still think you haven't seen the full expression of what that will look like, because ultimately that's one of the biggest areas where you can potentially control and do something about and create conviction earlier. So distribution. So I see that as a change as well, which is, I think, good, but the barriers are going to keep moving. And that's the other thing. I think you're going to have simultaneously the most amount of entrepreneurs we probably ever had. So many people having side hustles. You mentioned something earlier. I don't buy the one-person startup. I don't believe it. I think it's impossible to build, but I think it's possible that we might see the first one-employee startup, which is very different. So I do wonder if we're going to see a lot more prevalence. I'm seeing a lot more startups go the fractional route. Yep. I think that we're going to see a lot more fractional contract or consulting work, bringing in experts as you need and getting rid of them when you don't. So I think that employment is going to become a lot more fluid. And one thing that I didn't expect is, and I think because this affects some of the work that you do, is I think that's becoming institutionalized, which I didn't expect to happen as fast as it did, because a lot of the fractional work was near your network now. Yeah. And what I'm seeing now is no, they're hiring headhunters and recruiters to basically manage my flexible workforce is basically what I've seen. And I think that's actually going to be really key for the future. Yeah. Yeah. I've seen a couple companies start up that they don't do recruiting in the sense that I do. They have a bench of fractional experts and they just kind of farm them out, kind of like a consulting firm, but essentially they're coming in instead to do the work, it's to come in and advise and
and do a little bit of the work, but really kind of be a fractional CFO, a fractional CMO, et cetera.
No, but I've even seen traditional recruiters saying like, okay, here's the expertise I need for the next 6 months. Go find me that particular expert for the next 6 months. Okay, great. Now we're evolving into this area. Now I need this expert for the next 9 months. Go find that for me. And, I'd seen it up until even just a couple of years ago. This was done through networks, through informal means, and I'm seeing it much more formalized. I think this is going to become the normative. And so you're and it makes a lot of sense as a startup. Like, sure, I'd hire somebody, like you, an outsourced HR person, and not worry about it. Like, let me not rely anymore on my network. Let's actually get the best class operator I can in here. So I see that. Also, on my capital innovation stuff, I think I would like to see a lot of these new asset classes more normalized and accepted. I'm already, like I said, at least 65 different funds out there already operating in a venture adjacent manner. It's just we don't really have names for this. This is what I'm trying to do. And I think you'll see this a lot more normalized. And what I'd hope, and this is again, hope and inspiration, is that more LPs will recognize that a true diversity portfolio might be a little bit of venture, a little bit of PE, a little bit of SMV, maybe even some permanent capital. It's like, if I want to be involved and exposed in the technology sector, it may make sense to actually be this portfolio. And I'm also seeing a lot of even the mega funds start having funds that are actually non-traditional venture. So I see a lot more talk and I see a lot more acceptance of capital innovation.
Love it. Well, I definitely I could go down more rabbit holes and we could talk for another 2 or 3 hours, but I want to be respectful of your time. So let's kind of wind this thing down with a 3-pack of questions that I ask every guest. First question is, what's an influential book that you would maybe recommend to the audience?
Man, so
you mentioned a few, but
I do know I have a few, right? So the most poppy book, I still think Ben Horowitz is The Hard Thing About Hard Things. I actually recommend that to almost everybody. When I travel internationally, I think that book captures the closest to because entrepreneurship can be brutal. It's not a word that we like to talk about, but it can be brutal and it's really, really tough. I actually hate sometimes that it's that brutal, but it's a reality. And I think Ben Horowitz's The Hard Thing About Hard Things really drives the point home and also prepares people. Do you want this kind of venture lifestyle?
Yeah.
I'm an absolute geek. So like one of my favorite books of all time is a book by Igor Ansoff, which wrote a book called Corporate Strategy, which is one of the first strategy books ever to exist back in the 50s and 60s, where they were using statistics and management theory. And it's amazing how both applicable it is to today's work, but also where we ran into so many problems with it. So that's me being geeky. And then my third final geeky book, because I'm just such a geek, is The Lady Tasting Tea, which was a history of statistics. Okay. Because I think the modern world is controlled by statistics. And it's, we don't think about it, but statistics was invented in like the 1800s. Like it didn't really exist before that. Again, we just kind of made it up and put some math together. So those are books that were influential to me.
Got it. Awesome. What's your favorite thing to do outside of work?
I mean, hang out with the family. I have some beautiful kids and a beautiful wife, and you'll find us sailing. So my wife is a sailor. I am first crew.
Got it.
And I love riding my bicycle, and I still play guitar. I say this to a message. I have met so many folks. I'm middle-aged. I'm in my 40s. I've met so many people who used to play an instrument or do a sport or have something that I really cared about, and life gets in the way. And I get it, but man, like I have made sure every week to pick up that thing at least 15 minutes, if not longer, and it has made such a difference because it connects me to all the versions of Ethan that I've ever been. If you don't realize that you're kind of evolving pretty much like day by day, month by month, and year by year, but they're still an integral part of who you are. So there's something that's so powerful when I connect through music to all the versions of me, including all the hopeful versions of me and what I will build. And so I recommend, don't give up on the hobby. Don't give up on that thing that you've done.
Yeah. I literally played tennis for the first time this morning in probably 10 years. And so, because we joined a tennis swim club here in San Jose, and it's like, and I used to play not professionally or anything like that, but I played a lot when I was a kid. And so it's like, oh man, this is like really nice to get out in the court and hit the ball around. And I'm not as good as I used to be, but you got to start somewhere. So yeah, I totally agree.
Love it. And I love pickleball too, by the way. I just have to ask, what's your first feeling on?
So I'm a tennis purist. So like I grew up playing tennis. I've played pickleball. I find it not as, if I'm going for like a workout and I want to get a workout in, I pick tennis. I have not dabbled enough in pickleball to have it be the intense sport that I may want it to be, but they have pickleball courts, so we will get into pickleball as well, but I'll play both.
Fantastic.
Yeah. Awesome. Last question here. Favorite vacation spot?
Oh, this is a hard one. There's two places I keep going back to. Well, first of all, the beach. I'm a beach person, like through and through. And many people don't know New York actually has some of the most beautiful beaches in the world. I actually got married in a town called Ocean Beach, which is on a small island called Fire Island. And I go back there multiple times a year. We sail there every year. We hang out there. We got married there. And so that is one of my favorite places. And in terms of other cities where I keep finding myself go back to is Amsterdam.
Interesting.
I love Amsterdam, Netherlands. There are very few places in the world where I figured like whatever you're into, and I literally mean whatever you're into, you could have an experience. Everyone knows about the debauchery type of lifestyle there too. But if you just wanted to go to talk about flowers, you could spend a week flowers. Music, a week of music. Art, a week of art. Like literally whatever you're into, you could create that city and you could basically will it into whatever you wanted to. I told my friend to go there, who's, trust me, one of the most straight-laced people you'll ever meet. And she's like, this city is great. I'm like, because it can literally be whatever you'd like it to be. That's what I'm saying.
Fascinating.
It's an amazing city, and I've been there. I've taken most of my kids. I have one more left to go. It's ironically very family friendly place. They're great with kids. You ride. It's a 15-minute city, so you take a bicycle and you ride everywhere, and it's just So I love it so much.
I'll have to check it out. I've not been. It's been on the list, but have not made it to Amsterdam yet. So very cool. Well, Ethan, man, it's been a lot of fun to get to know you more and learn about your journey and all the things that you're into right now. If people want to reach out and learn more about what you're doing, connect with you about early stage, what's the best way to connect with you?
Yeah, so you can go to postunicorncapital.com and happily go to my LinkedIn, Ethan Mayers, ETHAN MAYERS. I'm easy to find. I'm easy to connect, and those are probably the two best ways.
Awesome. Ethan, man, really appreciate your time, and thanks for being a guest.
Thank you.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.